there are two options for preparing the statement of cash flows. There's the direct method that we're going to talk about right here. There's also the indirect method. Now, before you watch this video, if you have not yet watched my video called Preparing the Indirect Statement of Cash Flows, you're going to want to stop, go back and watch that video. It's a little lengthy, admittedly, but we go through a lot of the details preparing the indirect statement of cash flows. And the reality is this, much of what we talk about in that video also applies here. Because you see, the direct statement of cash flows does not differ in the investing and financing sections. Does not differ from the indirect method. The only difference is the presentation of operating cash flows. And even at that, the ultimate operating cash flow will be the same number. We're just going to present it in a different manner. So if you haven't watched this video, pause, go back and watch that one, and I'll see you in a few minutes, okay? Now, once you've looked at that video, the indirect statement of cash flows preparation, you'll recall that we had these transactions, right? Same transactions that are in my indirect statement of cash flows discussion, and we're going to use these as the basis for preparing the direct statement of cash flows as well. And just like you saw with the indirect scenario, we were going to take a look at the income statement for the month and comparative balance sheets. And just like in that situation, it's a brand new coffee house. So everything here is an increase. We don't need to see last year's or last month's balance sheet because we know it would have been zeros. January 1 balance sheet for this company would have been a bunch of zeros. So this is our template for the direct method. And you even start to see right now why the FASB prefers the direct method. Compare this to what you saw in that indirect video. In the indirect video, we started with net income and we added back depreciation expense, and then we added and subtracted changes in current assets and current liabilities, and we boiled down to a $1,500 operating cash flow. All right, great. But if you don't know financial accounting, if you haven't taken this class, that might be like a dog trying to read an instruction manual for your new TV. It doesn't make any sense, right? So what we have here is plain English. Cash collected from customers. You don't need an accounting degree to understand what that means. Cash paid to suppliers of inventory or cash paid for interest. You don't even need to take an accounting course to understand that. That's why the FASB prefers this method. Now, it's a little more complicated to prepare this method than the indirect method in most circumstances. That's why a lot of companies still choose the indirect method. So let's take a look. I want to show you the completed operating section, right? This is where we're heading. So the direct section, and you know from the previous video that the net cash from operations was a positive $1,500. And this is the way it's going to look with the direct method. Cash collected from customers, 40 grand. Cash paid to suppliers, 15 grand, et cetera, et cetera. What I want to show you now is we're going to go back and we're going to look at each one of these line items and explain where they came from. So remember, this cash collected from customers, we have it listed as $40,000. Well, where do we come up with that number? The starting point is going to be this revenue right here. Right? So we have $41,000 in revenue, but you and I know that was not all collected in the form of cash. Now, the reconciliation we need is right here. Because accounts receivable increased by $1,000, it went from 0 to 1,000 during the month. Even though we reported accrual basis revenues of 40,000, cash basis is only 40 grand, okay? So you see what we had to do is we had to take accrual basis on the income statement, then we had to look at the comparative balance sheets. If accounts receivable increased, we need to subtract that from our revenues to arrive at cash received from customers. If accounts receivable had decreased, we would actually add that. Back to the future. Here's the completed operating section for the direct statement of cash flows. And hopefully you don't mind this spoiler alert, but we see right here that it's going to say cash paid to suppliers of inventory is $15,000. I want to show you where that number comes from. And this is a little more complicated than what we saw with the cash from customers here. Because what you have to do is you have to start out here with this accrual basis cost of goods sold. But there are a few moving pieces affecting this, okay? The first thing we want to look at is our inventory. So inventory increased by $18,000. Okay, so we're going to start with the 12 grand. That's accrual basis, cost of goods sold. And to the extent that inventory increased, we're going to add it. Okay, so we're up to 30,000, which is no surprise because if you recall back from our indirect discussion, we had purchased inventory of $30,000 from our supplier, and then we had an inventory adjustment that reduced our inventory by $12,000. That created this cost of goods sold, and that resulted in our ending inventory of $18,000. But we're not done yet, because this is what we're trying to get at here is cash paid to suppliers of inventory. We didn't pay $30,000. These add up to $30,000 right here. We did not pay. We actually paid for half of that. So to the extent that you have an increase in accounts payable that you see right here, we have to subtract that. So cash paid to suppliers of inventory is actually this $15,000 right here. And you can really prove it to yourself this way. Initially, the company purchased $30,000 of inventory, and they did not spend a dime to obtain that inventory. It all went into accounts payable. So accounts payable increased by 30 grand because of this right here. Okay? And then later on, they paid half of the payable. So the $15,000 payment to the supplier is really the cash payments to suppliers of inventory. But if you don't have that level of detail, you can still back into that number by starting with your cost of goods sold and then adding back an increase in inventory and subtracting an increase in accounts payable. We're done with the heavy lifting because, reconciling accounts receivable and sales to come up with this cash collected from customers, reconciling cost of goods sold with a change in inventory and a change in accounts payable to come up with cash paid to suppliers, that required a little bit of analysis. Now, in this particular example, cash paid for other operating expenses and cash paid for interest is very straightforward because on our income statement, we actually did record these on the cash basis. Here's our interest payment right there of $500, and here's our various other operating expenses. Now, I did that intentionally to keep things somewhat simple. The reality is that in a real case scenario, you're going to have some accrued or prepaid expenses, and the change in those current liability accounts could and actually would affect the cash basis operating expenses. You also could have accrued or prepaid interest. You could have in the current assets section, you could have deposits from customers. You could have deferred revenue in a more complicated scenario as a liability. So any of these things has the potential to complicate your statement of cash flows. I chose to keep it kind of simple, just for illustration of the major concepts here. One final look at this slide that you've been seeing, the completed direct statement of cash flows, the operating section. You'll notice that this $1,500 matches the cash flow of the transactions that we started with. So that's a kind of a good feeling that those things match up. And then let's take a look at the indirect method. Okay, you already watched a whole video on how to prepare the indirect statement of cash flows. And what I'd like to point out is, here's your indirect statement of cash flows that provides information about operating cash flow, $1,500. The direct method shows cash coming in of $1,500. They give us the same cash flow. Operating cash flow is cash flow, okay? Whatever it is, cash is cash. It's the presentation that differs. The FASB prefers this method because, quite frankly, take a look at it. I mean, you could, without an accounting degree, without any financial background really, you could read through this and you could understand what it's telling you. You're getting the same information over here, but presented in a much more circuitous manner. Okay, the roadmap to operating cash flow here starts with net income, add back depreciation expense, and then you get your changes in current assets and current liabilities. And sure enough, it does prove our operating cash flow, but it's a much more indirect method. That's why it's called the indirect method. And one final comparison. This is the full statement of cash flows prepared under the indirect method. And here's your statement of cash flows under the direct method. Not just the operating section, but also the investing and the financing sections. Now, if you want a deeper dive on the investing and the financing, go back and watch that Preparing the Indirect Statement of Cash Flows video, because the reality is the presentation is identical. Investing here for indirect looks pretty similar to investing under direct. Financing section, yep, looks pretty darn similar. So what you see is the only differences exist in the presentation of operating cash flows.